House Democrats just released their American Families Plan, which includes major changes to the tax code that investors should know. Do any of these potential changes apply to you? Stick around, let's find out. Hello and welcome to another video from One Up Financial. I am your host, Eric Gersogna, here to help you increase income, reduce taxes, and invest smarter in retirement. Let's just get into it. There are significant tax changes coming should this proposal pass through Congress. While most of the changes only affect some of the higher income earners, there are some changes in here that could affect the majority of taxpayers. Here are the 12 most important proposed tax changes that investors should know. But before I get into this, remember to please consult with your tax or financial professional for further details regarding the American Families Plan proposal and how any of those changes may affect your personal financial plan. This is not tax or financial advice, but merely a summary of some of those proposed changes. So number one, the top marginal tax rate would increase to 39.6%, up from 37%. But this would only apply to those making more than $450,000 per year. Number two, S corporation profits would be subject to a 3.8% surtax, and there would be limitations on the Section 199A deduction. Really all that means is if you're in the top marginal tax rate, if you're a high income earner, you're a business owner, and your business is structured as an S corporation, then you could potentially be paying a top marginal tax rate of closer to 44%, not the 39.6% I stated earlier. Number three, top capital gains tax rate would increase to 25%, which is up from 20%. Now, the most important part of this change is not the increase from 20 to 25%, but that this change would go into effect September 13th of 2021. So, unless you have already entered into a contract to sell an asset on or prior to September 13th of 2021, then you could potentially stand to pay upwards of 25% on your long-term capital gains going forward in 2021 if you're in the higher income limit, if you're in the top marginal tax rate. Number four, an extension of the increase in the child tax credit. So right now there are some families that are receiving monthly checks that represent an advance on that increase in the child tax credit. And those monthly payments, those advances, would in a sense be extended through this year and at least into 2022. Number five, the child and dependent care tax credit increase would be made permanent. So if you weren't already aware, there is a tax credit available for qualified child and dependent care expenses. The increase would be $8,000 for one individual and $16,000 for multiple. Again, with a lot of these tax credits, there are income phase outs, so the more money you make, the less you'll be able to claim on your tax return in the form of a tax credit. Number six, and this is kind of the last of the new tax credits or changes in tax credits, and there would be a new non-refundable tax credit for caregiver expenses. Now, it's always important to really look and get a good understanding of what qualifies for caregiver expenses. But if you have qualifying caregiver expenses, you could potentially utilize a credit of up to $4,000 on your tax return with, again, there are income phase outs on this tax credit, and those income phase outs start at around $75,000. Number seven, and this one I think is very important because I know a lot of people, just in my experience, have utilized this strategy before, but number seven, the backdoor Roth IRA conversion would be eliminated. So if you're someone that makes more, if you're a married couple that makes more than about $210,000 in 2021, then you would be prohibited from contributing to a Roth IRA. But there was always a workaround. So what typically investors would do is they would set up another traditional IRA. They would make a non-deductible contribution to that IRA, and then they would take that non-deductible contribution and convert it over to a Roth IRA. It's referred to as a backdoor Roth conversion. And this new proposal would, in a sense, close that tax loophole effective January 1st of 2022. In addition to that, those that are in that higher income tax bracket, that 39.6%, would be prohibited from even doing what's referred to as a Roth conversion, which is simply just taking money from your traditional IRA and converting it over to a Roth IRA and paying tax on the amount that has been converted. But that wouldn't go into effect until 2032. So there's still kind of a 10-year window where if you're accustomed to doing a Roth conversion, you can continue to do so. Number 8, Roth and traditional IRA contributions would be prohibited for the quote-unquote wealthy. So it's always important to understand how they define wealthy. So based on my review of the plan, it looks as if those that are making more than $400,000 a year for an individual or $450,000 for a couple, and that's a key word there, and. So you have to make $400,000 to $450,000 and have combined investable assets in your IRA or defined contribution plan like a 401k in excess of $10 million. So if you have the income and you have assets in excess of $10 million, they're basically saying you can't contribute any more to an IRA. And this would be effective January 1st of 2022. Number 9, required minimum distributions would be imposed on, again, the quote-unquote wealthy. Same definition as before, $400,000 to $450,000 in income for single and married couples, and having that more than $10 million in IRAs and 401ks, you could potentially be required to take distributions from those qualified accounts and pay tax on those distributions. And the important part here is that usually required minimum distributions, or RMDs, are typically starting at age 72. But this new rule would, in a sense, force those wealthy individuals to start taking money out of their accounts and paying tax on those amounts much sooner, potentially depending on how old they are, than age 72. And this would go into effect January 1st of 2022. Number 10, and this is really important if you own cryptocurrency in a taxable account like a brokerage account. So number 10, the wash sale rules would include cryptocurrencies. So before I explain what that means, I have to take a little bit of a step back to kind of explain how the IRS treats cryptocurrency. Right now, as it stands today, the IRS classifies cryptocurrency as property, not as a security. All that means is that for the wash sale rule, cryptocurrency assets or cryptocurrency property does not apply, meaning that if you're utilizing, or if your advisor is utilizing, a tax loss harvesting strategy, which is selling an investment, realizing a loss, and then repurchasing a similar security in the marketplace, you can still do that right now with cryptocurrencies and not have to worry about that 30-day window. So for example, if you own Ethereum and currently your Ethereum is down $20,000 from when you purchased it, you could sell that Ethereum to, in a sense, take that $20,000 loss and use it to offset some income on your tax return or gains that you might have in other investments, and then go ahead and repurchase that same Ethereum the next day with a security like, for example, Apple. If you sold Apple stock at a loss and realized a $20,000 loss, you would have to wait 30 days before you could repurchase that Apple stock, or else the IRS would say, no, we're not going to allow that $20,000 loss to be deductible against your income. So it's important to note that right now, that tax loophole of treating cryptocurrency as property is still open, meaning the wash sale rule does not apply. But this new proposal would close that loophole and treat cryptocurrency as security, meaning the same wash sale rules would apply. This is a very complicated strategy when it comes to tax loss harvesting, and especially when you're dealing with cryptocurrency. So it's best to consult with a tax or a financial professional before you look to implement something like that. Number 11, the estate tax exemption would be cut in half effective 2022. So this was initially set to expire in 2025 as some of the provisions of the Tax Cuts and Jobs Act expired. But under this new American Families Plan proposal, that estate tax exemption amount, which would go down to $5.85 million for an individual and $11.7 million for a couple. So that would go into effect much sooner than what was initially planned. Finally, number 12, and this is more applicable to those that are utilizing some more complex estate planning techniques. But number 12, grantor trusts would now be included in the decedent's estate under this new proposal. So really what that means is if you're someone who utilizes what's called a grantor trust, or some are utilizing what's called an intentionally defective grantor trust, and a lot of people will use that strategy to shift assets out of their estate but still have the income on those assets be taxed at an individual level as opposed to the trust tax level, which is much higher. So that strategy would be rendered useless under this new proposal. So you can kind of get the idea with looking at some of these proposed changes. They're really looking at the tax code a little more closely and looking at some of those loopholes that are open and available to some of the higher net worth individuals and trying to close as many as possible. Now, there's a lot to unpack with this 800-page behemoth that they call the American Families Tax Plan. And this thing is complete with enough technical jargon to put you to sleep faster than a bottle of Pinot and a handful of Ambien. And I've only scratched the surface. But the key word here is that this is a proposal. Nothing has happened yet. So I would caution you on making any major changes to your investments or your financial plan without talking to a tax or a financial professional. If you're concerned about how some of these proposed tax changes may affect you or would just like to learn more, please call or email me. I will respond to you personally. Thanks as always for watching our videos. If you're interested in staying up to date with our market and financial commentary, please subscribe to our blog at oneupfinancial.com/blog or follow us on LinkedIn and Facebook. Thanks as always, and we'll see you in the next one.